Okay, first of all, thank you very much for coming tonight. It's winter's over. I live in Kelowna, and yesterday I was wearing flip-flops and a t-shirt, and I don't want to rub it in, but I hear it's been snowing like crazy in Alberta. I own 100 and something properties up in Grand Prairie, and my staff up there are just saying it's snowing like crazy up in GP, and I think they actually just had a snowfall warning yesterday. So it's just moving to BC. We moved 3 years ago, and it's just unbelievable right now. So really quick, who's been to our events before? This is our 8th event that we've done for free. So we have a handful. So let me ask a different question. Who is a first-time guest in our room tonight? Great. So thank you very much for coming. So that means we're all here to learn how to buy vacuum cleaners, right? So there's an Ultra Luxe that we're going to bring in. It's got this great power head. Totally kidding you. We're not selling vacuum cleaners. So who are we? We are the Real Life Real Estate Investing. And who I am, I'm your host. My name is Jared Hope. And for those of you who know me, I don't have to talk too much, but for those of you who don't, I'm going to talk a lot. So I'm an investor. I've been investing in real estate since 2003. I've transacted almost 300 properties. And I used to do, I've taught thousands of people across the country how to buy real estate. I was with Real Estate Investment Network. I was their main speaker for the last 7-8 years. I taught people how to buy, negotiate, kick people out, how to renovate. We did a renovate to rent program with RAIN. I've taught people how to do collections, everything from start to finish. And we started up our free events about 8 months ago. This is our 8th one, and this is our last one. And when we started up the events 8 months ago, we thought, let's go teach. Let's go give everything to everybody for free. Let's just go give it. And because I'm one of those believers that if you give everything as much as you possibly can, authentically as you possibly can, you'll get it back. So how this started out was we did them for free with the assumption that people are going to buy real estate, but they're going to buy it now, like they're ready to go right now. What's happened along the way, this is the reason why this is our last free one, is because along the way, the room keeps on getting bigger, right? Because it's free. So we change venues, so my costs go up because these things cost money. And then the room gets bigger, and what I've come to realize is people's buying cycles are a lot different than mine. I buy a house a week, not a house a week, house a month, maybe a house every 2 weeks. And you two are extremely tanned. So Joel's wearing a bright white shirt, and he's like just tanned, like it's just deadly. So every time I look to the left, I see these guys. So we started out down this path of doing these free events. Let's just educate. Because when my wife, Krista, she's actually the one who got us into real estate in 2003. I had no interest in getting into real estate. And when we got into real estate, we had no one actually holding our hand. We'd go sit in a room of 500 people or 400 people and listen to people talk and present. And then we were left to walk away trying to decipher and take away and break apart everything they said, and then we'd go buy a property. But along the way, we'd buy properties that didn't work. So along the way, we started buying properties that just didn't work. They didn't cash flow, they're in the wrong areas. I didn't understand tenant profile. I didn't understand quality. I didn't understand the long-term plan. I didn't understand, because I was listening to these presenters in these rooms, and it was all theory. It was too hard for me to understand because I had very little education to take that away. Okay, and I'm not bashing any program or any courses out there because they're good. It's the difference between U of A and NAIT. So if you want to be a plumber, you don't go to U of A, you go to NAIT. And you actually see from a plumber how they change the tap. You want to learn to be an electrician, you don't go to U of A, you go to NAIT. Yeah? Does that make sense? Does that resonate? So what I wanted this group to be is I want this group to be NAIT. We are the we are the real estate doing course. So 8 months ago, I thought everyone would just start doing. I tell them to go buy a property. Okay, I'll just go buy this property. That's what I thought I'd be able to do for people. But what I've come to realize is what's your name? Abel. Abel's journey in buying real estate might actually be a year. Because I'm so far down the line, I can just walk into a house and say, okay, I'm going to buy this house, and here's what I'm going to cash flow, here's what I'm going to do with it. I'm going to sell it in 8 years. This is my auctioneer voice. I'm going to sell it in 8 years, and here's what I'm going to do. Here's my tenant profile, and blah, 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 and away I go. Whereas Abel is going to take a lot longer to go through that process. So we are changing the concept of our TILT group, our TILT action group, okay? So I'm your host. We're going to get into a little bit more about me in a second. For those of you who don't know me, I put a lot of stuff on social media, okay? I love social media. I love Facebook. I love YouTube. And it's a great platform to get information out there. Okay? First of all, before I get into that, is anyone following this duplex stuff that's going on with the city and the bylaw? Is anyone following that? Who here thinks that they've passed it? Okay? I want to clear the air right now. I saw a post. So the whole thing about this event, I am a zero bullshit guy. You want to know how much I make? Ask me, I'll tell you. You want to know how much profit I make from a flip? Ask me, I'll tell you. You want to know what my service to debt ratio is? Ask me, I'll tell you. I'm full disclosure. Some people don't like that. You don't have to like me. I'm totally okay if you don't. I just saw a realtor's post from a pretty big investment group. And he has this post saying, good news! They have passed the duplex bylaw, Bill 12800. And he's pumping this shit. This bill is not passed, guys. It is not passed. So who's followed it? Okay, what step are they at?
We just pushed it back to August.
To August. And what are they doing in August?
We're just reviewing the studies some more.
They're going to review studies. So what do you do for a living?
I'm a hermit lender.
You're a what?
Private money lender.
Private money lender. Okay, well that's good. You can't lend money to my room. But, no, I'm totally, because I got to vet you. Okay, so here's the thing. Everybody in my room, I vet. So if you want to do business with somebody, I have to vet them because I want to make sure that his integrity, his level of commitment is the same as mine. Now, nothing against you, I'm sure you are. You have a killer jacket. But I got shoes that would go perfectly with that. So guys, this Bill 12800 is not passed. What's happened is they've pushed it to August, where now they're going to put it to the public and they're going to get feedback. So two things will happen. Do I think it's going to pass? Absolutely. I called a guy who used to be a former mayor in the city of Edmonton. I won't say his name, but he's the last former mayor. Okay? So I gave him a call, and I said, what's your thoughts on this? He also thinks it's going to pass. I can't say his name because it's being recorded, and I'm not saying, actually everyone knows who it is. But he also thinks, because this isn't the first time they've tabled this. It's going to go to the public. They're going to come back with all of their reviews. And if it's two things will happen. One, a lot of negativity, they'll collapse it. Okay? Or a lot of positive information and feedback, and they'll roll it out. So it's not passive. So be very, very careful buying this stuff. Which leads me to the whole concept of our tilt group. Our tilt group was created because I got sick and tired of watching people. I'm not an agent. I want to be super clear. I am not an agent, which means I can say whatever I want. Right, Geneva? Right? Geneva's a broker owner. You're going to hear from her in a second. I can say anything that I want. The main reason why we started up our group is I was sick and tired of people buying properties that didn't work because some agent told them that it did. It doesn't work. That agent is attached to a sale. If he doesn't get a sale, he doesn't get commission. If he doesn't get commission, he can't pay his car payment. That's how it works. So that's why I told this guy, you can't do business unless we vet you because I want to make sure that you're pushing a good product, right? So that's my little rant. That's who I am, okay? So does anybody have a problem with how passionate I am so far? No, it's cool? If it is, once again, I can't leave. You'll have to leave. So, okay, so why are we here? So some of you guys have been here multiple times. Some of you guys, this is your first time. So why are you guys here? Because I want to try to answer these questions. This isn't for me. I've bought over $100 million in real estate. I've transacted over $60 million, I've renovated over $60 million in real estate. I bought a property 2 weeks ago. I'm looking at a property next. I'm buying. So my commitment is to give back to you. So why are you guys here? I'm going to write it on the board. Abel, why are you here? I've seen you before.
To invest.
Okay, what does that mean?
Create a better future.
Okay, what do you want to learn?
From you.
Or just in general? Because I got 3 excellent speakers tonight.
Anything. Anything I could take.
Okay, so anything. Let's say everything. Okay, so Abel wants to learn. This is Abel. Did I spell that right?
Yeah.
Sweet. How about you?
To learn the actual steps to go from one property up to 2, up to 3. How do you get the cash? Where do you, especially with the mortgage opportunity, what are the practical steps? Because we hear all the theory, as you put practical steps.
Right.
Once
Totally.
you have all those properties, you have all
Then
that
what?
money, well,
Right.
how do you pay taxes? How do you get money out of your properties and still invest in those properties? How do you pay yourself even?
Okay. So I'm not going to be able to answer that for you tonight. Okay, because that's and I'm out of here. Hey.
You can stay, you can stay.
So, did anyone see the video I sent out to welcome you and thank you for signing up and make sure you come? Did anyone get that video? No. Well, because you didn't sign up. Anyone get that? You got the video. Anyone else watch the video? I was sitting at my desk. My wife was videoing. I was wearing a gray shirt. Anyone else? No one else saw that? That's probably why I didn't get a coffee. Because I said if you watch this video, make sure you bring me a coffee. Okay, so the progression of 1, 2, 3, 4, great question. Because what happens is people run off and they buy one, and anyone can, I don't want to say anyone can go buy one, but buying one isn't the problem. Buying two is not the problem. Buying three, having three now is the problem. Because one, how do you get to 4? How do you manage 3 with your life, kids, work, all that other stuff, right? So the progression, there is a strategy in it. Unfortunately, I won't be able to teach you that tonight because we've been working on this for the last 8 months, the progression. There is a way to do it. Taxes, I'll introduce you to my accountant's going to come up. We're going to talk about that in just later before the break. So he will be able to help you and assist you with the taxes, but that's an important one. How to pay yourself is an important one. But the real estate journey is an amazing journey. I started out in 2003. I bought my first property in 2003 for $147,000. I sold that house in 2008 for $432,000. But in 2003, I bought 3. My second year, 2004, I bought 8. My third year, 2005, I bought 64. Then I bought 32, 28, 25, and I just kept on buying. Today, I've transacted almost 290 properties. So real estate's a fun game. What else? Taxes. We can help you with that. What else? Joint venture partners? Yeah. Okay, so Arlen Dolan's here tonight. Arlen, where are you? How many joint venture partners have you had? Or total? 12, 15 joint venture partners. I've had about 10, 12 joint venture partners. We're going to dive deep after the break about joint venturing. What else? This is going to be a short night if no one has anything to do. Corporate structure. Great. So law, legal. So I have a guy named Darren Richards who last 2 months ago, I think we talked a little bit about corporate structure. We had some questions. Darren's part of our premium service provider group that I have created for everybody. I'll introduce you to Darren before the break, and then you can talk to him at the break. So he'll be able to help you out with that. Anything else?
Strategies to renovate, refinance.
Okay, reno.
Flipping houses to yourself almost.
Reno, flip, reno to rent. Okay, once again, I won't be able to answer that tonight, but I'm the guy to do it. So right now, we're on pace to do 22 flips this year. And I think right now I have 11 on the go. So in the last 7 years, I've done, I bet you I've done 80 properties. And all I do is I buy, reno, flip. I used to buy, reno, rent, and now I buy, reno, flip because I have 100 and plus, and I don't want it anymore. I just want to. So what I do is I renovate. Brenda Bastille is probably a really great lady to talk to. Brenda, she has a really cool, funky glasses in the back. She's also doing what I'm doing, so lots of knowledge in the room to help you out with that. We also, in the September or October, Sasha, I don't know if we have it, October, we're going to do a reno day. So we're going to put on a 1-day course. I'll bring in my renovators, speakers, mortgage guys. I got a guy out of Calgary that we borrow money from. I might have a new guy here that we borrow money from in a cool pink jacket. So we got that covered. Okay, what else? What, Carlos? Market report, as in what? The buying market or the rental market? Both? Okay, so let's call it a market update. Okay, what else? One more thing. Anyone else?
Legal versus non-legal suites.
Oh, Sweden, good question. Anyone own versus non? Anyone own non-legal suites? Brenda, yeah? Yeah? Okay, so hang on. Legal versus non, great topic. So why wouldn't you own a non-legal suite again? Brenda, hang on.
Well, I have been fined for fines.
Yeah.
And
So who fines you? Like, how does the fine happen?
the fine happens because probably someone has complained, a neighbor, and then the city will come in and say, we need to do an inspection, because something's not sweet. Fine, they come in. You know, I have quite a number of them, so
Right.
sometimes they'll just let me legalize them and it's fine, but I have actually been fined twice,
How much do you get fined?
$1,000.
Yeah.
But one I'm fighting, and he's allowing me, I think May 2nd is my court date. And so when I went the first time, he's allowing me to legalize it.
Right.
So he said, which, okay, fine, I'm willing to legalize them.
Yeah, you just need time to do it.
But I had so many that I just couldn't do
Yeah.
them all at once.
Yeah. I just got busted in Edmonton. My partner and I have a property on the north side. Tenant called and said there was no smoke detector in the basement. So I said, okay, great. I'll get it priced out. In the meantime, she ended up calling Health Services. Health Services comes in, and now I got flagged for a non-conforming suite. I have one up in Grand Prairie. Tenant did a move out. We didn't give them the security deposit back. They called Health Services, and they complained about plugs, plug covers that were loose. Health Services came in, saw the basement suite, flagged it. So tenants do the darndest things, right? So would I buy a non-conforming suite? Yeah, I don't think I would, to be honest with you. I own dozens of them still, but the problem with owning dozens of them is right now I have two, a lot like Brenda. I have two on the go. One's going to be probably a $70,000 reno, and the other one's going to be a $25,000 reno. So all of a sudden I'm $100,000, ish out of my pocket to renovate these things, when that's after mortgage dollars, right? Whereas if I could have bought a brand new house that's already renovated, already legal, all of a sudden, I'm not putting that 70, 80 grand. And yeah, the purchase price is a little bit higher, but I'm only putting 20% of that down because that's my down payment. Does that make sense? Okay, so great. If there's anything else, I want to be a crazy interactive group. So we have a bigger room than maybe last month. So we'll try to answer as many questions that we have. I got to get my mic working so we can record all this stuff, but so I'm going to get on that. So follow us on Twitter, follow us on Facebook, Tilt Property Group, Tilt Properties. I am all over Twitter. I am all over Facebook. I love it. I think it's a great, like I say, it's a great media to start putting stuff out there, and just whatever's going on, we just post it. So Tuesday Tilt Talks. This is my partner in crime. Krista is the one who got us into real estate back in 2003. We went into a workshop in October 2003. I went away for lunch, and she stayed and listened to the info session, and she came back, and next thing you know, she signed us up for 17 months at $300 a month. And the first 6 months, I did nothing because I was right pissed off. And for the next, I told her it was $300 a month, and at the time, we didn't have any money. We had good jobs, but we didn't have that extra disposable income to spend $300 on this real estate course. But we went to it, and 6 months later, I said, this is enough. I'm going to go buy a property. And I bought a property in the wrong area at the wrong time, didn't understand my tenant profile, and it was a mess. That was my second property. My first property was good, but my second property was in Montrose. And knowing what I know now, I'd still buy in Montrose, but I'd understand who lives in Montrose, because I didn't understand who lived in Montrose at the time. I thought I'd get a good accountant or a good doctor that lived there, and that's not necessarily true. So does everyone know where Montrose is? Yeah? So Montrose is, where the Coliseum is? It's like across the street. Yeah? It's like, yeah, don't buy in Montrose. Really quick about me, I'm an investor first and foremost. I've been around these other investment rooms for a long, long time. Scott McGilvery, for example, you can go to his website and he'll say on his website he's bought dozens of properties. You go to my website, I've bought hundreds. RAIN is a very good program, very good education system. It's a theory-based system, but unfortunately, those guys who are running it are a theory. They don't really own a lot of real estate, and I know that because I'm partners with one of them. And I'm not out to bash them. If you want to learn education, go see RAIN. They're a great program. I wouldn't recommend you go see Keyspire because they're going to hit you for 20 grand or 15 grand up front. If anyone's a Keyspire member, they don't like that. I'm sorry, that's just my opinion. I'm up at the front, I'm allowed to have an opinion, okay? So that's just the truth. That's my opinion. Take it for whatever it's worth. You do what you want with that, it's up to you. So I'm a coach, I'm a personal mentor. I'm extremely passionate about real estate. I love real estate. In 2003, when we bought our first property, I never thought for a million years my life would be where it is today. The first 12 years were extremely hard. We almost went bankrupt in 2009, 2010. I had $500,000 in the bank by 2008. In 2010, I had $0 in the bank. And I was on the verge of bankruptcy. Darren's here, I believe Wayne's here, my accountant. They can vouch that story. I was almost broke. I was literally months away. In 2011, we changed our focus, changed the way we were doing our business, created a dummied down version of Tilt, and then over the years, we've just evolved Tilt to what it is today. So I've renovated 100 plus properties. These are with clients. I've done 70, 80 on my own. We do these for clients. Yeah, but more importantly, I'm an investor. I'm literally playing the game. I'm teaching you to play. I'm not making this up. I'm the plumber in the field changing the tap, okay? So that's what Tilt's about. That's what we always want to be about. Some of us learn from other people's mistakes, and the rest of us have to be the other people, okay? I was one of those people that had no one telling me of the landmines that I was going down. I was going down a path of real estate with other people's money at that point in time, as well as mine, and I was stepping all over landmines from buying the wrong properties that didn't cash flow, wrong reporting to joint venture partners, no reporting to joint venture partners, lying to joint venture partners, siphoning money from one account to pay for the other without telling my joint, I was making every mistake in the book. My third property, I went up to a tenant who didn't pay rent for 3 months. I share this story often because it's kind of funny. His name's Eric. Wife's name was Rosa. So Eric and Rosa owed me like $8,000 in rent. Finally, I didn't know what to do. Finally, 8 o'clock at night, I roll by their house on a Sunday, knock on their door, answers the door. I'm going to grab you. Grabbed him by the ear. I pulled him out, and I said, Eric, you have 2 hours to get the F out of my house. If you don't leave, I don't know what I'm going to do. I let go of his ear, and I left. Like I was vibrating. I was going to kill the guy. This is my second house I ever bought. Come back 2 hours later, gone. Completely gone. It was unbelievable. I came back and I'm like, thank God, because I didn't know what I was going to do, because I would have had to have done something, right? So he ended up leaving, and so that was a mistake that I don't want any of you guys to make. I have a property management company. You don't have to use us. I have a realtor division. You don't have to use us. I have a renovator division. You don't have to use us. I have a collections division. You don't have to use us at all. I would advise you to use people who are actually playing the game. Because if you're using someone who's not playing the game, the advice they give you is incorrect. There's lots of coaches out there coaching. There's lots of coaching and mentoring going on right now. And there's all kinds of organizations pumping coaching. But if you actually look at the coaches doing the coaching, really dig deep into it. Just don't take their word that they're good. Look at their profile. I sat down with this investor from Sun Life. Chris and I sit with this guy at Sun Life, and we go through this whole thing, and he's pitching us these products, and I'm just like, great, that's so cool. Tell me what you got. Tell me how much you make. Tell me what your portfolio is. And he's like, well, this is a little bit different. You have more equity. I said, I totally get that. But what's your portfolio? Never answer. I'm like, dude, that's great. Good job. I'm out of here. I can't invest my money with somebody who's not doing it himself. I'm not saying he has to have as much money as me. But if he's not playing the game, how can I say, here's my money for you to go play the game? Why would I let him play with my money? That makes no sense. So why would a joint venture partner want to do business with you if you can't do it yourself? Why would you follow somebody if they can't do it themselves? That makes no sense to me. You don't like that comment? I'm sorry. That's the truth. That's my opinion of it. Okay, what's Tilt? Tilt is 100% your one-stop shop. So I won't talk much about myself, but for the next hour, it's all mine. That was a joke. So we're a one-stop shop for income investors. You want to sell your house, you're a homeowner, you want to sell your house. You know what, I can give you some strategies on how to move your house. I can give you some strategies on how to market it, but I'm an investor-specific person, okay? Like I'm all investment properties, okay? What we do is we help people manage it, we help people buy it, and we help people learn. We have a learning education division now, which is our Tilt Action Group, our TAG, okay, which is our acronym. So What we want to do is be able to help you buy, sell, but more importantly, we want you to invest. Not just invest in real estate, but invest in your future. Invest in not your future, but also maybe you have kids, maybe their future. When my daughter was born in 2005, she was born May 21st. May 21st, I closed on a house. Because I told my wife, now I was negotiating this house before she was born. She wasn't supposed to be born until the end of May. But on May 21st, I had to remove conditions on a house. And Chris is like, what are you doing? I'm like, this house is hers. That house, and like I still have it today, we paid $153,000 for that house. That house is probably $500,000 today. I met with this guy, this Sun Life guy, and he's talking about RESPs. And he's like, you need to do RESPs. I'm like, no, I don't. Well, the government's going to match you $500 or whatever it is, right? I'm like, that's cool, but I don't need to do it, man. Well, you can make this much money. So I said, okay, tell me. He's like, well, in 10 years, you can have $75,000. That's awesome. In the last 10 years, my daughter has a $500,000 house. That house was $153,000. I put 25% down. So I put $40,000 down on this house, and now it's worth $500,000. Think about that. That's not bad. I'm not saying don't buy RESPs. I'm not saying don't buy RRSPs. I'm not saying don't buy stocks. And in fact, I'd say, pick one and play the game hard, and then dabble smartly with the other two, stocks or RSPs, right? So, or RSPs. That's what I would do. So our mission is we want to talk about what's working. We want to find and teach, how to implement the theory. Real life, zero BS. That stands for bullshit. There's zero bullshit in my room. If I say something you don't like it, put up your hand and say, listen, Jared, I disagree with you. Okay? Sean, you filled out a comment form a while ago saying Jared's facts or something was off. Just call me on it. Because I'm not saying, no time do I sit here and think I'm perfect. There's lots of things I don't know. I have an opinion of stuff. Doesn't mean my opinion's correct. Your job is to take away stuff I put on the table and say, I like that, I didn't get that. I'm going to look into that further. Don't just close the door on it. Look into it further. Dive deep and see what's right. Okay? Is that clear? Okay? I just want to be clear on that. So even with any of the speakers that we bring up, it's just their opinions on stuff. Now, I have personally vetted these people to make sure their opinions are accurate. Think about that. Okay? But I seriously personally vetted them. I make sure that the people that are standing in the room, one, everybody in our room, every speaker, I get no kickback of. Okay? I'm not taking 25% of a deal from them. I'm not taking any referral fee. I'm getting nothing for these guys. Okay? So I make sure that when they come into my room, I'm making sure that they're going to be able to back up what they say. So follow us on Facebook and Twitter. Tonight, I have 3 speakers. These people are some of the best that I feel I've ever done business with. Geneva Tatro. Geneva Tatro is a broker owner, associate broker owner now because she just teamed up. She owned a company called Century 21 Vantage, and they just merged with Century 21 Masters. Geneva's been in the business 15 years, 16 years, past president of the Edmonton Real Estate Board, extremely knowledgeable lady. So she's going to come up and give a market update. Heather Toma is with FCT. She's going to be talking about title insurance. Title insurance is something that I wish I had known about in 2003. In the last 6 deals that I've bought, we've put title insurance on these properties that I'm buying now. So title insurance is it's a game changer in my opinion. Okay, so she's going to talk about that. Arlen Dolan. After the break, Arlen's going to come up, and we're going to talk about joint venturing. Anyone want to know about joint venturing? Few people. At some point, you will need a joint venture partner if you want to keep on growing real estate. I don't even care if you have endless amounts of money. With the way the banks have changed their rules, back in my day when I was buying real estate, I didn't need, banks were handing out mortgages like this, right? They were called ninja mortgages. So, but nowadays it's so hard to get the banks to approve after 3, 4, or 5. I have a guy who's gotten 8, and the bank finally came and said no more. So now joint venture partners have to start kicking in. However, joint venture partners, if you go with a joint venture partner, you still have to declare who your joint venture partner is. So they still have to report it to the bank. So the game is changing a little bit. Banks are still, did anyone see the mortgage rule or the interest rates didn't change? Interesting, eh? Who thought they were going up? You did? Why? Do you mind me asking you why? Why do you think they're going up?
So because they say that Canada is moving in,
Canada's moving.
yeah,
Where's it moving to?
direction in terms of,
Is it going further north? I hope not. It's so cold there.
in terms of the economic with the
Yeah,
oil,
economy's booming.
they're projecting that with the Trans Mountain pipeline,
Yeah.
things are gonna go up
Yeah.
at some point. So based on those factors, then we're thinking, okay, then, the prime rate might have gone up.
What do you do for a living?
I'm gonna come to
Oh, an accountant. There you go. So here's my view of mortgage rates. I actually, don't quote me on that. Actually, you can quote me on this one. I wasn't surprised they didn't change. With what's going on, with home prices are dropping, we're starting to see inventory shooting up in Vancouver and Toronto, which means eventually house prices might drop. I'm not saying they are. But when there's a huge amount of inventory and your neighbor besides you is trying to sell your house, what are you going to do? You're going to lower your price because you want to sell your house, which means eventually the prices might start dripping down. I'm not saying they're going to, but I'm saying they could. And if they do, the Bank of Canada, the feds are right now sitting there, I think they raised rates too much. I think they thought, actually I know they thought, because they were saying that GDP growth was going to be 4% at the start of the year. And now they've reduced it to 1.8%. So they dropped GDP growth down by 2%. They sliced it in half, which means they don't think the economy is buzzing as much as they think it is. So I actually think by the end of the year we'll see a rate drop. That's what I think is going to happen. 48% of mortgages in 2008 are set to expire, renew in 2018. 48% of them. Interest rates have gone up, which means payments will go up. And if payments go up, you have to make if the interest rates went up another point, you'd have to make 9% more of your income to pay that. Who here gets a 9% raise every year? Nobody. So the bank's treading on very thin ice right now. I do not feel they'll raise rates. In saying that, if you buy the right property in the right area and you get the right tenant, you get the right cash flow, if they raise rates 0.25 or 0.5, you're still okay. If you buy the right product, okay? But it's just things to pay attention to. So Arlen Dolan's going to be coming up, we're going to be talking about joint venturing. There's no secrets about joint venturing. We're going to put them all on the table. Arlen and I are going to talk about mistakes we've made, lessons we've learned, things we'd do differently, successes, everything. We're going to answer questions. If you have any questions, write them down because we're going to get to them. Okay? Feedback forms. Everyone's chair has a feedback form. I really want this filled out. Tell the truth. If you rate us, all of our speakers, we want to be rated because we want to find ways to keep on improving, keep on giving you the information that you want. If you don't like a certain thing, if it's too cold by a door or too cold, there's water outside the door. We had a complaint once that there was no water. The water's outside the door. There's 2 bathrooms directly through that. Don't go through the wall, but go around. There's 2 bathrooms right there, women and a men. So men go in the men, please. But please fill this out. There's two forms. One is a rating us, and the other one is if you want to be contacted by us. So if you don't want to be contacted by us, don't fill this out. Okay? If you want information, fill it out, and we'll reach out to you over the next little while. Okay? Now, Geneva. Dun, 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 dun. Geneva Tatro. I met Geneva last September, a year and a half ago, 2 years ago. And before I started down the path of doing any kind of business or having Geneva come up and be part of our events, I actually did business with Geneva. And one of the very first things I said is before I do anything with you, I have to make sure that you can actually do it. Because I won't do business with anybody. Make sure that's on.
Yeah, the first time that I met Jared, he dragged me around looking at houses to show me what the investor experience was like. And I was quite interesting watching him go through properties and quickly analyze what would work and what wouldn't. And it was a really awesome way for me to figure out and really understand exactly what he does in his world and understand that process. And through that, then I've had lots of exposure and experience with him and just understanding what that path looks like in the investor world, which is very, very different than the regular home ownership world. So like Jared said, we had 50 realtors. We just merged last month. We became a brokerage of 100. And we see every single kind of real estate deal out there. We've worked through lots of booms and busts and everything in between. So it's an interesting world that we work in. And as much as I wish, and people ask us all the time, what's happening in the market? What do you think is going to happen? It's a crystal ball. It's all speculative. But we are able to look at some trends and see what's happening and make some assumptions based on what we've seen in the past and what we see, rubber hits the road. And it's interesting this year, the weather always in our spring market plays a huge factor on what's happening in real estate. If we have a relatively warm January and moving into the spring, we see people get out of their homes quicker and that market starts to move sooner. And this year, January started out not too bad, then it got really cold, and like February, I think people ran into their homes and closed their doors and hadn't barely stuck their heads out since. But we're starting to see that lift already in our marketplace with the activity happening. So we'll go through a little bit of the information here. So what I wanted to talk about were some of the market influencers. I want to really scale things down and really talk about what's happening in Edmonton, but obviously there's other factors that play a role. So obviously the market is really impacted by what's happening at our local, provincial, and obviously national and even international levels. We recognize that right now as we see, the federal government making changes to the way mortgages are done or putting certain taxes in place that they think are going to impact certain marketplaces and also then impact marketplaces that, they weren't necessarily intended for. I was just commenting to somebody at the beginning of the night here about the tax that BC has put in for out-of-province owners on their properties. And unfortunately, that's a direct impact hit on Alberta because lots of people that live in Alberta own properties in BC. Probably we are, for sure, I would say the number one out-of-residence owner there. And so there's a huge impact on that. So all of those things play a role in what people do as where their feet land on their day-to-day. Employment is huge. What's happening in the economy and for the employment. One of the nice things is as we've gone through this last 3 years of recession, is that Edmonton was really propped up by a lot of the construction and development that was happening, the downtown core, what was happening out at the airport, a lot of those projects happening in and around the city. And so we had a lot of construction jobs that helped maintain a little bit of that, where we saw a lot of other places losing jobs. We also have a huge public sector marketplace or employment sector here. So that really helped us carry through where Calgary saw huge job losses. There were definitely months where Edmonton actually brought the numbers into a positive because all the other areas were so negatively impacted. Net migration is huge. Obviously, Alberta is the place to come when there's jobs to be had and money to be made. We see lots of people coming here from all over the country looking to land and live. Unfortunately, when oil prices dropped and everything kind of hit the wall a few years ago here, we saw a lot of people exiting out of the province. So we'll take a look and see what's happening with the migration back into Alberta. Recession and recovery, we were in a 4-year recession. We haven't seen a 4-year recession in a long time. Even when we saw the market crash in 2008, we were going hard up and we hit a wall and it dropped off and it changed overnight. But that was an actually fairly quick recovery, all things considered when we look at that. So this is one of the longer stretches that we've had in a long time. So looking at how that impacts us and where we are in the incline of that. News and media is huge because everybody looks at those pieces and hears the negative or the whatever. Negative news always gets more attention. So one of the things that we always talk about is, and I talk to my realtors about, is not so much what you're reading or hearing, the speculative stuff, but what are we feeling? What are we hearing from our clients on the streets? What are we seeing at our open houses? What are we seeing in terms of offers coming in? So the news media can have a huge negative impact on how people react because they react speculatively based on what they hear. Obviously, what's happening in our inventory, so we'll look at that quickly, and then where is that consumer confidence and get an idea of where that is. So I have a few charts here that I'll show you. Some of them are a little bit small. It's not so much that you can see the numbers, just you can kind of see what's going on. So obviously you can take a look and see what's happening with our net job creation. This is in Edmonton, so you can actually see that we managed to actually sustain ourselves relatively okay. And then we did see that slump down, but we saw a lot of those construction jobs that were happening in and around the city that employed an enormous amount of people, like Rogers Place and those kinds of things, start to come to completion. And so those jobs did at a certain point drop down. But what we can see is that we're starting to see some positive gains back on the side. So basically the number of people working in February was up year over year by 1.6% net gain from the same position in 2017. So, we're not seeing huge increases, but we're just seeing that kind of becoming a little bit flat in there. The unemployment rate is interesting. You can see how that gradually increased as we went through some of the challenges there, and you can see that decline starting to happen now. So we see those numbers as being really positive. The jobless rate in February 2017 was 8.4%, and currently we're down, 7.2. So we're starting to see those numbers soften a little bit. We're on the right way on that decline. We're not making any great, the gains aren't enormous and spectacular by any means, but everything is heading in the right direction. So this one is interesting, our net migration. So you can see how positive everything was for that period of time and then how quickly it all dropped. And we all felt that. We used to say that there was cars lined up to get out of Saskatchewan, no offense to Saskatchewan. But now, we went through a period of several years where we saw people really exiting out of Alberta. But we actually see really positive gain as we got to the end of 2017. We have here, this was actually the highest fourth quarter net migration in the last 4 years. So we're starting to see people come back. We're starting to see that those jobs up and people looking to come back here. One of the numbers that's really interesting, or the stats that interesting, is that how young our population is. We have a really young population in the province. We have people that are here to work, want to earn money. So it's a place where people are entrepreneurial, they're not hardworking people. They want to get out, find jobs. If they lose a job here, they're going to go try to find something somewhere else. So the other thing that we like to look at is the new home starts. And so this is important because the builders obviously are really responsible for helping our communities to expand and grow what's happening in the cities. And so you can see that we had some pretty strong new home starts over the years, and then we did see that pull back. One of the things that's different in this last 3-4 year span compared to when we saw things hit in 2008 is that the builders were very reactive this time to pull back on their new house starts. So they knew right away when things kind of hit the fan that it was time to pull back, and they dropped numbers very, very quickly. Whereas in 2008, they got cut in the middle of a boom and everything was in the ground. And obviously, if you're building construction, new homes, it's pretty hard to turn that off overnight. So if things are already started, those things have to complete. But we did see, and I worked with a lot of the new home builders on different committees and things that I sat on, and we saw that they very quickly, very reactively cut their numbers and started slashing. So that did soften that negative impact that it could have had should they have continued on a little farther. They reacted immediately. Okay, so I'm just going to get into some stats now from the real estate market. These are all factual numbers based on what's actually happened. So just to give you an idea, I like these numbers. They show us what's happening on our average price categories. We are going to focus, more on the overall averages, but we've got our single family homes. I don't know if you can see the numbers here. We're up marginally. From last year to now, we actually haven't seen a decrease in our single family home prices. Our duplex row houses, this is a really volatile price point in a product because we have infills, duplexes, and things going in. I just showed one last week, and that duplex half was $800,000, and there's a duplex down the street that's listed for $350,000. So this is a really volatile price point, and we see really extremes. Condos are the same. I can show a condo to somebody that's listed at $99,000, and I can go out the next day and show them one that's listed at $1 million. So the category is enormous. So we see more fluctuation, and the price points in them become a little bit skewed because they're not always comparing apples to apples. Our row house duplex and our condos see a little bit of negative impact on price. Condos are the one that's the toughest thing, really not where we're looking at and what you guys are going to focus on for the investor market, but we have an enormous amount of condo inventory. And if you're dealing with investment properties and condos, you're also dealing with your condo fees and all those extra things. So I don't want to focus on that too much. Okay, so looking at the average sold price, this is overall. What I want to show is just some of the trending that's happening here. So when we started last year, March, the average price, this is all categories combined, was sitting at $377,000. And what we're looking at today is $374,000. So over the course of the year, we're seeing things being pretty flat. We're not seeing huge dips and swings. You can see that in the increases. This is a typical year for us, is seeing a slow start in the spring, seeing the numbers pick up and greater increases in our summer months. You can see that there's some fluctuation in there, and then it comes down in December, January, cold months. We all go into hibernation. This is a number that we look at all the time just to kind of get an idea of what's happening. So gives us an idea of what kind of a market we're in. We've obviously, we're sitting high and pretty high into the buyer market. And we've been sitting that way for a while. We have almost 6 months worth of inventory on the market. Our current listings, this is Edmonton only, are sitting at just over 5,800 with just under 1,000 listings sold in March. So just gives us a quick scale to see where we're sitting. Obviously, we're a long way for a seller's market. Definitely deep into the buyer. Our listing absorption rate gives us an idea of what's actually happening with all the inventory. So on the charts here, again, not too worried about the numbers, but wanted to show you the bars along the bottom are showing us what either the gray is an increase compared to the month before, red being a decrease. And those are the properties that have sold. And the light colored bar sitting above it shows me the inventory that's unsold. So that's unsold, expired, terminated, or just still active but sitting there. So we can kind of get an idea of what's happening. So currently, of all the inventory in the market, 17% is selling. So if you listed your house with me, you have a 17% chance that your home is going to sell compared to the other guy. So those numbers are, they're moderate in there. There's lots for people to look at. There's definitely a lot of stuff sitting there that people are considering. One of the things that we always want to consider is that the unsold inventory does always include overpriced inventory. And sellers take a long time to adjust in their prices, especially we've been dealing with majority, for a number of years, back since I've been in the real estate market in the early 2000s, with sellers really being able to benefit from pretty good gains year over year on their homes. Sometimes it's only a few percent, sometimes it's greater. But when I go to a seller and say the housing market has decreased from here or there, it's very challenging for them to understand that. And so we see a lot of people still want to put their home on the market at the number that they think. Some realtors will continue forward and do that. And then when that home starts to reduce in price, people look at it and say, oh, the market's falling. They had to reduce their house by $40,000. No, they didn't. It isn't that the market fell by $40,000. It's that house went on at the wrong price to begin with, and all they're doing is catching up with where it needs to be. So there's a lot of stuff in that unsold that has a little bit of a story with it. It's not just all inventory that should be sold and isn't. Okay, so our active and sold listings. So this chart just shows me what's sitting. The gray is the total inventory or that's active, and then the bar at the bottom is showing me what's actually sold. So now I can see that fluctuation. You can see how we move into our spring and summer market. It increases and drops down. One thing that I found interesting is I wanted to look at where we were this March compared to last March. So we're sitting at about 5,800 listings, whereas when we were March last year, we were at about 5,000. So we have about 800 listings, just over 800 listings more right now than we did this time last year. Our sales have dropped a little bit, but not too bad. The month over month, so actually year to date, year over year, I wanted to talk about, that's down by 11.67%. So we are seeing that softening right now, but we're still in that place where people are just figuring out what they're going to do. So average days on market, this just gives you an idea of what we sort of see, what we saw in the last 12 months over the course of the year. So you can see that the numbers have kind of fluctuating around that 50 and up into the 60. Over the December and January months, we got really fat. Not a lot of people were looking. Those days on market creeped up there quite a bit, and start to see that come down a little bit again. Now, I don't expect anybody to really see that chart at the top, and I put that on there and laughed and thought Jared's going to call me and say, Geneva, they won't be able to read that. This is going back all the way to 2008, and the only reason I put it on there is I wanted to just kind of give you an idea of what the norm is. That's a pretty big span of time. That's 10 years of time that's on there, and you can look. We've got 57, 56, 63, 65. You can see it ballooning up over the winter months and then shrinking down as it goes. So we're not dealing with anything out of the extreme norm here. I don't have any 80s on the chart there. We're not looking at 100 days on market or any of those kinds of things. I did pinpoint a certain point in time, and I expanded it down here because I wanted to just show you what '08 looked like in terms of the days on market. So we were sitting as the market changed in there, approximately ending the year with 65 days on market. And here we are this year sitting here, and we're about the same. So that days on market is very comparable to where we were in that '08, but we hit 60s, 61s up there before as well. So we're sitting in that scope of time that's not that different.
Can I just say something?
Yes?
So when I see this, I don't have a mic, so does everyone hear me okay? Yeah? So when I see this, I see trends, okay? Like I look for the pattern inside of it, okay? So here's what I see. So in 2010, we came out of the recession. A global recession happened in 2008, 9, 10, right? The whole world almost blew up. So in 2010, we went, Q1 we were 49 days. 2011, 48 days. 2012, 55 to 48. 2013, 58 to 44. So in 2011, 12, 13, what happened to the market? Started picking back up. Oil went up, multiple offers went up, house prices went up. Everything started coming back. So the market was buzzing. There was multiple, Keith, where's Keith? We put on hundreds, literally hundreds of offers. And how in 2010 to 2014, so say we put 100 offers. How many were multiple? 100? Right? Almost every one was multiple in that time. But start watching the days on market, 48, 44, 40 is the lowest in 2014. That's when things were just buzzing like crazy. And today we're at 55. So we peaked at 72, 70 something. Where was it peaked? What's this? Oh, 17. So 66, we peaked at 66. I think we actually got a little higher than 66.
Yeah.
And then it started to drop back down to the point where now we're at 55. So start following trends and following patterns versus watching a house sit on the market and all of a sudden it's selling for $20,000. Oh, the market's dropping.
Yeah.
It's not. It's just some agent who priced it wrong.
Well, and the other thing that was interesting when I pulled this and looked at it is, I don't know if you can see these numbers at the bottom, they're small, I know, but it actually shows the interest rates. And so the interest rates back in '08 were basically 5.5, 5.2, 5, and then we see, like, I look at it all and we're running, now into the 2s, it's amazing actually when you look at that and see how that interest rate, how it affected what was happening in '08 versus what's happening right now, and we're sitting at, definitely less than 5.5 and 5.2, so there's lots of positivity there. Yeah.
But could those also, these coming years, or this 16, 17, those interest rates are lower, but they're not reflecting the new mortgage laws where you have to qualify for basically those
That's right.
2008?
That's right. So they're basically putting that they put that rule in place that's making people qualify where they needed to before. So they've all qualified there and not that long ago. But yes, you're right, 100%.
One more thing, Brenda. In 2000, what was your highest interest rate you've ever paid for a house? Now, Brenda's, I love picking on Brenda because she's just like a quiet little doer. It's awesome. So,
Probably
17.
well, back in the 80s.
Okay, was it a rental?
Yeah.
Okay, so in the last 10 years, what's the highest interest rate you've paid?
The last 10 years.
Yeah, last 10, 12. 6%? And did it cash flow?
Yeah, it cash flowed at 17.
Yeah. So the whole point, the reason why I'm asking is, who gives a shit about interest rates? Let everyone else start talking about interest rates. Who cares? If they go up 1 point, Brenda made it work at 17%. My highest was 6.9, and I made it work. So don't worry about interest rates. That's my point.
Okay, this again is that, I already showed a micro piece of this chart. It just shows our inventory versus our solds. But again, I just wanted to pull out that piece from 2008 to now and just compare it. And look how high our inventory was. We had 10,000 listings, 9,000 listings. Like we're sitting at 6,000, 5,000, 4,000. So really, relatively speaking, we have not seen that influx of inventory that we saw back in '08 when every single person and their dog got caught with their house listed for sale. We are not in that place, and not by a long shot, not just by 500 or 1,000, but by 5,000. This map here just shows what the average prices are around the city, and so obviously we're seeing a lot of focal points kind of in this southeast part of the city, that's that Mill Woods area and whatnot. We're seeing the price points are really nice for the investor market. Looking at that, Jared obviously talked about the locations and whatnot that you should look at. But you also see in the north part of the city, those price points are sitting that little bit lower, and that's where you start to see that inventory that's, those nice size bungalows, maybe they're original, start to need some work, maybe really well kept, maybe starting to see the renovations. But the price points in those two communities are really reasonable to get into. Okay, so I wanted to talk a little bit about what's happening kind of at a street level when I'm talking to people about what's happening in the market. So I want to talk about the recovery market first. So really what we're seeing right now, what I'm seeing, and I've been seeing this a little bit last year, but even more so this year, and as I talk to my realtors and we talk about what's happening on a daily basis, what I call is these hot spots, these different things that are going on. Like I'll talk to this realtor and they'll say, we've had this house listed for 2 months. Nothing, not even a showing, and it went into multiple offer last night. And that's happening more often. So these little pockets, like why is that happening over here? This one I listed and I thought I nailed the price, nobody's showing it. This one, I don't know, I thought it'd be a hard sell and it's gone. So really randomness in the market, that always speaks to a recovery market. It means that there's not consistency happening there. People are buying based on certain needs. So there's no consistency. Like I'll spend lots of time with my clients and say, this is where I really think you need to be on price, and nothing. And this one over here that's high, and it all of a sudden gets activity. So the hot spots are really indicative of a recovery market just because there's no consistency to it. The randomness, same thing like I just said, we're just seeing like nothing and then a flurry of showings. And so there's like, I can't put a consistency on it. I can't sit in front of a client and say, for sure, this is going to be the outcome. If there's a guy sitting across the street waiting for a house to be listed in this price or in this location at this price point, we'll sell it tomorrow. And then if they're not, then we might be still sitting here in 2 months or 3 months. The pricing challenges are really hard. I touched on this before. The sellers are always hesitant to get into like where their house price really needs to be. And so it's very challenging for us to really talk to them about what's happened and really help and encourage them to get the price correct. And price is really key. That's what's going to, especially when you have a lot of inventory, that's what, everybody's going to shop against. So our sellers are hesitant to reduce or even to start at the right price. And then when they do the reductions are not necessarily, as I said, because of the falling market, but just because we're actually saying, okay, see, nobody's coming through. We need to get you more in line with what is going on. The second thing to consider is the consumer confidence. So, it's funny because when I became the president or chair of the Realtors Association, I had to stand on stage and give a speech to 2,000 people. That was my opening thing that I had to do. And it was like the day that oil tanked. I think the month before it tanked. And I was like, oh, really? So I had to speak to media all year long. I had to deliver speeches about what we thought we were going to see in the real estate market. And it was a really trying year because people were stressed and everybody wanted to know what we thought was going to happen. And we just were like, we don't know. This is what we think, but we don't know what's going to happen. And then people started to have to make decisions based on guesswork. Am I going to have a job next week? There's layoffs. There's 100 people going into work today, and we know that 50% of them are coming out and going home. Everybody was showing up at work every day wondering, am I going to have a job tomorrow? Am I going to have to survive on one income or two? So that speculation piece was hard. It may or may not have impacted you. Lots of people it did. But a lot of people were impacted simply because they were worried about that impact, and so they ended up reacting to it even though it may not have actually affected them directly. So what we're seeing now is that people are making decisions, again, based on fact. For the most part, and I know this isn't consistent across the board, but for the most part, if you have your job today, you're pretty good now. We know that. Or if you did lose your job, you found another one. People have gotten back to that place of stability, so that instead of making decisions based on speculation or the unknown, they're finally able to make some decisions based on fact again. So the realities are we a one-income or a two-income family? Do I have a job or do I not? My workplace is stable. The landscape seems stable. So people are finally kind of coming up and saying, okay, I know these variables now. It's not scary every day. So they're out doing fact finding. We have lots of buyers that are asking questions or open houses. I don't know. I talked to two of my realtors this weekend, and just after last weekend, one of them had 30 people through an open house. Another one had 22. People are going out again, but they want information. They're not quite ready to go. The interest rate stuff has also made some people hesitant, but they're finding out information. They're curious. They kind of got pushed back into their spaces for a little while, so they're ready to come out and look around. The benchmark qualifying rates for sure have impacted people. The ones that that just rolled out this most recently, we're seeing have less impact. That was on the people that were, putting down your 20% or more, and so are not that high ratio mortgage. And for the most part, that's because those people aren't maxing out. They're not at their top price point. If they're putting down 20% or more on a home, they likely have already home ownership in play, and they have a significant chunk of money they're putting down. They're not buying at their max. So the most recent one had the least amount of impact. The ones that impacted our main pool of buyers with the qualifying rates, those changes came out over a year ago, almost a year and a half now. For the most part, people have looked at that and they know what's happening, and they've had some time to kind of rebuild and understand what that looks like.
Just a question on that. So how does the mortgage changes affect the buyer? We were talking about this before.
Yeah,
Right?
yeah. I mean, when
this new mortgage rule affected the 20% people.
yeah,
The last one was, everyone
Yeah.
under 24.
yeah,
Less than
the high
20%.
ratio stuff. Yeah,
So how did that impact the buyer?
it dropped what their purchasing price was significantly. Yeah, it did.
So then what options do they have at that point? So you're out, because we
Yeah,
talk about this all the time.
yeah. So, I mean, we were seeing a first-time home buyer as an example, and it's not just first-time home buyers that were impacted, but they would be coming to us and saying, I want to buy a $400,000, $350,000, single-family home. Now they're coming back to us and saying, okay, maybe that isn't the first home I own. Maybe the first home I own is a townhouse or a condo. So they've adjusted. It took them a bit of time, but they adjusted, and now they're buying just at a slightly lower price point.
Right. And if they don't buy, what happens?
Then they're staying in the rental market.
Right. Because at the end of the day, if, the 300, 350 price range, they'll roll into a duplex or a townhouse. But the ones that are 500, 600, they can't qualify, so they got to drop down. They enter back, a lot of them will enter back into the rental world.
Yep.
They'll rent for a year, 2 years, save their money to go enter back into the buying world in a year or 2 years, right?
Yeah, and a lot of them did that and said, I don't want to buy an apartment condo or whatever. I'm just going to sit it out for another year, save some more money, and then go back in. And so it puts them back into the rental market again, for sure. The next thing is our inventory. So just a summary from some of the stuff I've shown you. So we almost do have 6 months of inventory supply on the market, and we are at the beginning of our spring market. So we do expect our inventory to increase. It always does this time of year. We're already seeing it across the board, the amount of inventory that's going in on a weekly basis. But, again, I look at those 08 numbers, and we have a long way to go before we're at talking about that kind of a scenario. There's 17% of homes selling and 83 are not. Those follow into those categories we already talked about. The days on market currently compared to the end of 08, so not too far off that. Sales are down from last year, and inventory is a little bit higher, and overall the prices have remained pretty stable. So, when I look at this, I look at it and think it's a pretty good time to get into the marketplace if you are going to buy, because there's extra inventory. Sellers are saying like, hey, look at me, I'm better than the guy next door and over here, because there is still those options. So there's some motivation from the sellers. Also kind of buying after we've gone through the fall and winter market and early spring market. There's some sellers that have had their homes on for quite a period of time, and they're starting to get a little anxious. Like, what am I going to do if I don't sell it? Should I rent it? So there's some opportunity there for some good deals on properties. The next thing is the active buyer profile. So who are these people? I've touched on this already a little bit. So we do always see, actually Darren mentioned this to me just before we started here, and I totally agree that we often see the commercial kind of part of our marketplace start to move first when we see that recovery and people feeling that confidence back. Obviously, the commercial guys, the dollars are higher. They're different kinds of deals. They're looking for actual deals on things, and they enter back in. And then the next thing that we always see is that our investor pool always starts moving first. They're always the one that starts with the traction before we see everybody else go. They're a little bit more riskier. They also know that there's an opportunity to get some good deals and whatnot in the marketplace. And definitely we've been feeling the investor group working around us and looking for properties for definitely the last few months, if not year. New buyers who have planned and are thoughtful about their needs. So maybe took a step back last year and now are like, often what we find is once people do decide they want to get out of the rental market, if they have the means to save and be smart with their money, once they've decided they don't want to rent anymore, they do want to get out and buy. They want home ownership. There's some people that will rent forever, and that's great because obviously that feeds the need that you have. But we do see that some of those new buyers have had a year, just over a year, to kind of figure out what they need, and so they are coming back out of the hole and looking around. And then we also are seeing experienced buyers with just changing personal needs. So somebody's having a baby, their home has grown, they need to downsize, whatever it is. So that's kind of what we're seeing in the marketplace right now. There's not a lot of people that are selling yet that don't have, like, unless they're selling because they need a change, not because they are just going to test out the waters. When we see, a 5% increase each year, then there's lots of people that are like, yeah, I'll put my house on the market because if I can get that dollar, I'll find something else. So they will just list and move and sell just because they can, and they'll make some money doing it. We don't see those people playing right now. Most of the people that are on the market is because they have a need. So the opportunity, definitely the sellers, there's a lot of listing competition still. Even though we're way off where we were in 08, we're still high in our numbers, and that definitely creates that competition. The days on market are higher. Buyers financing is not always straightforward. So, there's definitely some concern in that those buyers are, the deals are getting a little bit longer and harder to put together. So if you're in a strong position to come forward with a strong financial offer or know that your financial position is good, then you're in a great place, because we're seeing more deals fall through because of financing now than we have in a long, long time. The banks have just really tightened the reins on lots of stuff, and people can go in thinking that they're good to go, and then something comes out of the blue and it's done. So there's more risk in that for the sellers right now. As I said from the charts, the net migration is up, and definitely the new people are having impact on the market. They're coming in again, they need places to live. Most of them are going to rent until they either decide where they want to live, or they're going to rent until, and stay in that rental pool until they can afford to buy. We're seeing some stability in the economy now after the last 4 years, and prices have remained really overall relatively stable.
That's it?
That's it.
Everybody. Geneva. Savannah. So really quick, is there any questions for Geneva?
Yeah.
From what's sitting, like, I know they say 17% of what's on the market selling. From what's sitting on the market, how much of that is above average selling price? Like, do we know, like, is it? I have a chart that breaks it kind of down into price ranges, but it's all across the board. Like, we've definitely seen, I would say stuff kind of 450, 475, and kind of up to 600 is really flat. It's a really hard market right now. The stuff below is moving fairly well, and that's because it's not just first-time buyers looking at it, but it's also investors and other people. And then the higher-end stuff it's impacted, but not as much, because there's still tons and tons of money, and in the community, in the city. And so what happens with the higher-end stuff is that a buyer that's been waiting for a good deal, but at a high-end property, is coming in and buying them. So we were kind of seeing that middle portion is struggling a little bit more. Like, a really good example of that price point is in the Hamptons. Like, when they built the Hamptons, they built everything within a couple years span, and pretty much every house in that community, is between 18 and 2,200 square foot, 2-story, and it's pretty much on the market between 475 and 525, or maybe 450 and 500. And like, when I pull in there, I can pull 50 active listings, and it's like, well, what's the difference between all of these? So that's the one that's really struggling. We're seeing much better movement in the stuff, under 375 and under. Yeah.
Good question. Anyone else? I have a question. Now, as an agent, you might not be able to answer some of my questions.
Okay.
So, if that's the case, just say pass. I plead.
I will.
Which you can't do in Canada, but you can try. Where do you think the market's going to go in the next 12 months?
I think we're going to see just stabilization. I think that we're going to see people coming back. Like, we've had so many changes in the last several years, like, never mind what's happening in the economy, but with the mortgage rule changes and all the other things that are going through, I think we finally are at a place where we're not going to see as much change, and we're going to see some recovery. I think we're going to see some positive gains. I don't think we're going to break any records. We're not, going to see, huge increases, but I think we'll see decent numbers, and I think sales will continue.
So is it safe to say that it could be normal?
Yeah.
Right? Like,
Yeah.
we're not, oh my God, the world's falling apart, and it's like, oh my.
Yeah,
it's crazy.
that's what we're hoping, is that there won't be anything new that comes up. And right now, that's what I feel like. It's like all these little people are poking their heads up out of the ground like little gophers, looking around, and they're not being scared back in. Like, I feel like there is that sort of, okay, it is what we think it is, let's have a look. So yeah, I think normal would be a good way to describe
Okay,
it.
so one more question. You said that anyone who's selling a house right now is selling because they have a need to sell it.
Mm-hmm.
What would be 2 or 3 negotiating tactics that you could share with people to go buy that house from a seller who has to sell the house? If you were representing me as the buyer,
Yep.
and we went and found this house that Sid is selling, how would you want?
Well, if we went and looked at it today, I would really be talking about the fact that we're just at the beginning of our spring market and we're about to see that typical push of inventory come on. So right now, you might be one of 10 homes in that community that's listed for sale, but probably in 1 month's time or a couple weeks' time, we might be up against 25 properties.
Right.
So supply and demand is going to play a huge role. And, if I was going to negotiate for you, I would probably
Because you know how I negotiate.
put the fear side more so into
Hang
the
on,
client
tell
side.
everybody how I negotiate.
Ruthlessly.
Right? It's so
Yeah,
true.
but I think, as my job as an agent, when I'm acting for my client, like I believe we're in normal, I believe we're in stable. But if I'm negotiating for you, that's not the message I'm delivering to the other realtor.
Right.
I mean, I'm going to say to that realtor, oh my God, do you think the interest rates are going to go up? And what do you think the bank's going to come out with another change? And Jesus, the inventory is going to spike right away. Like I'm scaring the crap out of them because if they don't know what they're doing, then I've got a leg up because I'm pummeling them with information and they're like, oh my God, I know, they should just accept your offer. So, I think that the beginning of the market is a great time to negotiate hard because we don't know yet what it's going to look like. I mean, we have good information, but they don't know.
So is it common for the next few months inventory to creep up?
Yeah.
Yeah, so we're going to continue to see inventory sneaking up,
Yep.
sneaking up, sneaking up. That doesn't necessarily mean house prices are dropping.
No, because we have a lot of buyers that haven't really started looking yet. Like sellers start to list as the weather turns better and the spring market comes, but our buyers also come out of their holes. So typically our inventory increases, but our sales start to increase. But again, that wouldn't be the message that I would use if I'm negotiating. I would just simply talk about the increase in the inventory.
Because the media right now is going to start shining a light on inventory.
Yeah.
They're going to start saying, oh my God, there's more inventory. They're going to start shining a light on
Yeah.
the inventory. When the truth is, it's still moving. Things are still moving. Carlos, one more?
So, I guess from your experience then, when it comes to like areas like Terwilliger, like nicer kind of like upper scale areas, are they just letting the listings expire or are they actually just dropping things down? Not like the ritzy areas, but like the nicer.
Yeah, I think it's a combination of that. I wouldn't say it's all one or all the other. I would say it's really based on the client's needs. We're definitely having more clients say, I think we'll just take it off the market and maybe rent it or whatever. But most people, if it's on the market, there's a reason. So, in those kinds of areas, it really comes down to the seller and how rational they are on what's happening, And so if I've got somebody that really understands the housing prices and the gains that maybe they've seen over the last number of years or whatever, then it's going to be really talking to them about what's the right decision for them. I can't say that it's sort of one or the other. Yeah.
Good.
It's not a very good answer to your question.
And I would answer that question. It all depends on the buyer.
Yeah.
Like if you got to sell, you're selling it. And if you don't got to sell, you're going to take it off the market. Right now, what we're seeing is we probably get, Heather's not here, Sasha might know. How many emails, actually, you might not know the total answer. We probably get 8 to 10 leads from into the property management division from clients, from people who want property management. Of those 8 to 10, I bet you half are people who can't sell their house and they're turning it into renting it because they don't want to lower their price any more than they already have. So we're seeing half and half. So half are from investors and half are from homeowners who are transitioning into landlords because of the market. So, at the end of the day, if you got to sell your house, you're going to sell it. And if you don't got it, you're not going to sell it, right? So one last time for Geneva, a round of applause. That was awesome. When I met Geneva in 2016, September, when I met Geneva, like our first conversation was lights out. She got it, she understood. She was, I don't want to say ruthless with negotiating, but she understood how to negotiate. She understood how to go, pitch a deal to get me my product. And I'm big on low balls. I'm big on just throwing in prices and just see where it goes. And I went to Geneva and said, listen, here's my approach. And she's like, yeah, okay, let's start there. It's a starting point. It's not the end point, but it's the start point. And then she would go in and she would negotiate. She is awesome. Highly recommend Geneva. She's one of my favorite people. So here's some takeaways that I've gotten from that. So obviously, I just didn't make these slides up as she was talking. I saw her slides beforehand, and I created some follow-ups. So back in 2008, this was a common phrase. People would, in 2005, 6, 7, as oil's jacking up and interest rates are down and things are just booming, everyone was coming to Alberta for work. Everyone was coming to Alberta. In 2008, 9, 10, everyone's leaving Alberta. They go home. They just don't lose their job and go get a job next door because there are no jobs, because at that time, the bulk of jobs were in the oil and gas industry. So 2008, 9, 10, we saw a decrease of population. In 2011, 12, 13, 14, we saw an increase. Everything started pumping back in. Jobs were hard to find, and prices were going up. People were paying bonuses to get them in. They were flying them back. Thanks, Ash. They were flying them back. I'll do it at the break. They were flying them back. They were paying them bonuses. They were doing all kinds of stuff for the oil and gas to get them back. In 2015, in October 2016, we actually saw the market drop. And the market started dropping because Henday stopped, Rogers Place stopped, all these big jobs that employed a lot of people started going away. Calgary rolled into the recession in 2015. Edmonton, it was a little bit of like a bubble, like a fake thing, because we actually entered it in later on in that year. So then what starts happening is we've always been taught, and I've always believed, that you want to be below the national average of anything, of the GDP, of employment, of rent, of everything, right? So if this is the unemployment rate, Alberta's unemployment is like 7%, right? It's like 6.9%. Canada is sitting at just like 5.5%. So Alberta, we want to get under the national average, because that's going to start showing that Alberta is the province to be in. So who thinks that this is a real number of 7% of unemployment? Well, it is a real number. They're not making it up, but it's an average of two things. So Todd Hirsch of ATB, he's an economist, he puts out the next slide. But before we get to that, 6.7% is our unemployment in Alberta. Edmonton's 6.7, Calgary's 8.2. Why is Calgary a higher unemployment than Edmonton? It's white collar. Who said that? Yeah, it's white collar. It's all head offices. So you go down to Calgary now, you go downtown Calgary, it's still, the companies haven't come back. Why don't they come back? Because there's no work yet. Grand Prairie unemployment, 0%. 0%. I just approved 8 rent increases for May 31st because they're fixed term leases. So a year ago, we started seeing the market change. So we started changing our lease terms. So we started going into fixed terms. In 2014, we were doing 2 3-year terms because I saw the market dropping, so I wanted to lock them in longer, right? And that's part of the benefit of owning 152 rental properties. I follow trends really, really well. So what happened in Grand Prairie is, I just approved 8 rent increases. One was $1,000, went up to $1,650. Another one was $650, a 1-bedroom apartment, went up to $925. Another one was a main floor, $1,000, went up to $1,600. Another one was a basement suite, $800, went up to $1,350. Like, we're doing $600 rent increases, 60% rent increases. The funny thing is, in 2015-16, when the market started dropping, tenants were calling me saying, hey, listen, if you don't drop my rent $600, I'm out of here. And I'd be like, no, listen, dude, here's the thing. I'll drop it $300. We'll keep it just above. We'll meet in the middle. But if rents ever go back up, I'll never raise them. No, this is bullshit, man. Lower my rent or I'm gone. Fine, $1,000. Now, out of these 8 rent increases, I guarantee you I get 6 phone calls. Hey, listen, can we do $1,400 instead of $1,600? Because I've been getting these calls for the last 6 months. No, we can't. Because remember that conversation we had 2 years ago? I told you I'd never do it and you still wanted a lower rent. Unfortunately, I now have to come bring you back up to market. Thanks for being such a great tenant, Sylvie. You've been unreal. I really want to take care of you. Oh, I got nowhere else to go. I'm sorry. I got to go to $1,600. So that is how Alberta works. We can do unlimited rent increases. Okay?
Jared, what's the vacancy rate up in Grand Prairie?
0. In Grand Prairie, we're probably -2 vacancy rate. We have 0, it's unbelievable. To the point where Bobby sent me my pre-approvals, because I decide my own rents. She sent me my rents and she's like, yeah, this 3-bedroom main floor, $1,500. I'm like, go 16. She's like, we won't get it. I'm like, says who? Supply and demand. We have mass supply, low demand, go $1,600. We went 1,600 and we had like 4 or 5 people want to take the place. So that's what, but on saying that, it's going to shift. Okay, so that's Grand Prairie. Grand Prairie's boomer. I think you have some in Grand Prairie, don't you? No, you used to. Grand Prairie's boom or bust. Okay, when the boom, it's amazing, and the bust, it's not so good. So if you dissect this 6.7 even further, did anyone see this report that these university people put out targeting millennials, the top 10 towns for millennials? Anyone see this? I posted it on Twitter and Facebook. Who here targets millennials? Nobody rents to millennials? Just Carlos? Yeah, you might. So here's something interesting. Watch this. So out of all of the tenant profile, it's so important to know your tenant profile. Because your tenant profile, now you might not be able to see this, but I'm going to tell it. The blue line is the unemployment rate for millennials. The yellow line is the unemployment for everyone else that's not a millennial. So if this is our unemployment rate, 6.7%, and you're targeting millennials, your actual effective unemployment rate is about 12%. Interesting, isn't it? So now you have this report that just came out, and everyone's saying, oh my God, this report is awesome. It's actually bullshit. If you don't understand who's going to, like, what's a millennial do? Millennials don't like to work. Is that not the truth? Most millennials are being supported by their family, their parents. Most millennials go to school forever and they just keep on going to school. Most millennials want granite countertops, but they don't want to pay for it. They want their dad to pay for it. That's how millennials are. Nothing against them. That's just the way it goes. So understanding your tenant profile is crucial because people aged 25 and up, we're hovering at 5.5%, which is the national average. Millennials are pushing 13.5%. Understand your tenant profile. So that 6.7% unemployment rate might not be real, depending on who you're targeting. So a couple things that I've noticed from Geneva. Geneva talked about days on months on market, 5.88 months on market. That's how much inventory we have. I follow trends and patterns, okay? In January, we had 6.48 months of inventory in January. In February, we had 6.78. So we're dropping. We've gone from 7 months of inventory down to just under 6 months of inventory. So we're seeing more volume hit the market, but yet months of inventory are starting to move. So our months are starting to drop. How is that possible? Because days on market are starting to change. So remember, we bottomed out or maxed out, I guess, topped out at 40 days on market. Now we're at 55, 56 days on market. That trend is starting to decrease. Last month it was 58, the month before is 60 something, the month before is 60 something. So we're starting to see days on market starting to move. Once again, the reason why a house doesn't sell is because the agent priced it wrong. The agent went in and said, hey, Berto, what do you want to sell your house for? 400. Great, I'll sell it for 400. I'll list it. Because what agents do is they come back and say, okay, I'm just going to get the sale. I'm not an agent, so I can say anything that I want. Okay? This is just my experience. It's my view. Agent will come in and say, Berto, what do you want for your house? 400. Okay, I'll list it for 400. And then they come back and they say, listen, Berto, your price too high. You got to be 380 because we're not getting any calls, no showings, no nothing of this. And a lot of times they don't even come back and do that. They just put it on the market just to get a sign on to get other calls for a form of marketing. So just because it's on the market doesn't mean anything because I've bought many houses for that they're asking 350 and I got them for 300. What they're asking doesn't matter. You just got to go in and find the right way to pitch the deal and get the sale, right? So days on market are crucial. So I start watching trends. I fully expect days on market to continue to drop. If they continue to drop, what's going to happen? We're going to start seeing house prices go back up. We're going to start seeing multiple offers. Vinny, is Vinny in the room? Vinny's one of my agents. You're going to meet him in a second. We do lots of business. In the last 3 months, out of all the offers, how many were multiple? Most. Almost every offer is multiple. Vinny's called me up and he's like, yeah, Jared, there's 5 cars sitting outside right now. That's happening right now. Days on market so you start listening to the noise of, oh, inventory, it's a smoke show. None of it matters. Interest rates, none of it matters. Buy based on facts and fundamentals. Right now, we're starting to see a trend in this way. And say I'm wrong. Just say I'm lying and I made a mistake. Oops. If you still buy the right house in the right area with the right cash flow, it doesn't matter. Do you know what house prices have gone up on average in the last 25 years? 5.28% in the last 25 years. Pretty good. So this is a chart that I use often. We started to see GDP growth, employment's growing, population's growing, increased rental demand. We're seeing decreased vacancies starting to happen. I think we're here. Edmonton hasn't started to see rent increases yet. On tenant turnover, we're starting to raise them $50 to $100. We're not actually sending out rent increases like we are in Grand Prairie, but in Edmonton we are. What happens in Grand Prairie 6 to 8 months will roll into Edmonton. Grand Prairie right now is buzzing. There's all kinds of oil play, there's methanol play, there's all kinds of activity up in Grand Prairie that's driving people there. What's happening now is people don't want to live in Grand Prairie. Anyone been to Grand Prairie? It's not good. So what will happen is the families will live in Edmonton, the guy or the wife, whoever works, will commute to Grand Prairie, work there, and then they'll come back because there's nowhere for them to live, so they have to look at other options. But the pay is so great in Grand Prairie right now that people are starting to move. So we're sitting right here, hovering into this spot. How do I know that? Because GDP, we're going to lead the way in Canada for the next 3 to 5 years. Employment growth, Alberta's been kicking everyone's ass in employment growth all across the country for the last few months. Population growth, we've been kicking ass. We're starting to see huge increased rental demands. This is really starting to happen, okay? So follow us on Facebook and Twitter. Heather Toma. Heather Toma, hang on, no. Heather Toma is, once again, is someone that I know personally. And this is someone that I've done business with. My sister's done business with. I vetted Heather. Heather works for a company called FCT, and she's going to talk about title insurance. Title insurance is something that I wish I had known about in 2003, because I've had properties that I bought that were trashed. I had properties that had reno issues. Unbelievable, right? The stories are endless amounts, and Heather might share some of those stories. And her and I talked a couple of months ago. We were out for drinks, and I'm like, Heather, can you come speak at my group? And I had to beg him, plead, and I had to buy you some drinks, and you ended up coming out. But so with that said, round of applause for Heather, please. Sorry about that.
Thank you, no worries.
So a little bit about me. My name is Heather Toma. I am the sales leader here in the Prairies for FCT. What does that mean? That means I do a lot of this. I do a lot of talking and a lot of walking. And really it comes down to making sure that we are giving the right education to the market. One thing about title insurance that a lot of people don't know is there is a huge lack of understanding of what title insurance covers and the risks that you inherit when you buy a property. The single biggest risk that you have is something that nobody through the process, your realtor, your lawyer, your prior seller, is going to be able to identify, because the secrets in the walls are the scariest secrets that you will ever find. And I'll tell you guys a little bit about those today. From a fundamental introduction, what is title insurance? Title insurance is actually a special type of insurance that is designed to protect the marketability of your actual title. What does that mean? That means you can have a very lovely house, but if you have a dirty title, you can't do anything with it. You can't sell it. You can't finance it. You can't do anything. It's so important, and a lot of people don't understand the scale of risk and the types of things that they're exposed to when they're buying properties. What I can tell you about Albertans today is roughly 40% of homeowners get a policy that covers them. Almost 100% of homeowners buy a policy for the bank. You're under an impression that that policy is going to protect you. But I'm here to tell you today, it's not. And I'm going to give you some live examples of why it's not going to cover you. Title insurance is designed for 3 major areas. The first one is the one that's a little bit easier to understand and mitigate, and that is main title issues. There are 2 types of issues. There are unknown defects and there are known defects. What's different about FCT is we actually look at both. Most title insurers in the market say if there is a known defect, so there is disclosed problem on that property. For example, your entire basement that you renovated was done without permits, okay? That is a recipe for disaster. Companies like FCT will come in and we will look at it and we will say, what is our opportunity to help you in this situation? We will underwrite it at the time that you send the application to us, which is really important for all insurance. You want underwriting at the time of application, not at the time of claim. Now, when you look at that at a time of application, we're going to be able to say, yes, we can cover that risk, or no, we cannot cover that risk in a known situation. But in an unknown situation, you're going to run into a situation where now you own the property, you've been the owner of the property for a period of time. On average, 7 years is when our claims actually populate. An average homeowner has a claim that comes up 7 years later. So you've owned this property for 7 years, and you get a municipal enforcement. And that municipal enforcement is for a non-conforming suite. Or that municipal enforcement is for a lack of permits for a structure that was put in. You are now financially responsible for all of the costs associated to remedying that situation. I'm going to go through just a couple examples for you guys today of what some of those things come up, specifically relating to investors, because your interest and your risks are going to be different than that person that moves in from an owner-occupied standard. The second one that comes up commonly is actually our off-title issues. These are probably the biggest and the scariest. These are the secrets in the walls and the things that you can't mitigate. In the past, we had a bit more, I would call it, conversation that happens during a conveyancing process. Now, because of privacy law, it becomes a lot harder to get the right answers on whether or not something is or isn't a problem. But more importantly, as an investor, what do you want? You want to make the most money you can out of that property, right? So do you want to inject your money to solve problems, or do you want to inject my money to solve problems? If any of you say your money, call me any day. Because any of you, I think, would be confident in saying that you don't want to spend your money on your property, you want to spend my money on your property. The last one is transactional issues, and this is our title fraud, this is our survey-related issues. One thing that I have to say fundamentally, title insurance did wrong when we came to the market 26 years ago, was we came in and we said, don't worry about an RPR, just get title insurance. I don't think that's right. I think an RPR is a very valid document. It will tell you, is everything built where it is supposed to be? And I can tell you, things aren't always built where they're supposed to be. Even when they're brand new, they're not built where they're supposed to be. That being said, 7% of our claims would be related to something identified on a RPR. You know where most of our claims come from? Lack of building permits. Does that surprise anybody? I challenge each of you to spend the next 6 hours of your life watching Home and Garden television and tell me if any one person talks about a permit, because they don't. Jillian Harris never talks about how she does the work, just shows you the pretty pictures. How you do the work is so important. Who you're buying from is so important. What I've found is there's kind of a bit of a misperception. You're buying a resale house, sure, title insurance comes in. I'm buying a new home. I don't need title insurance. I'm buying a condominium. I don't need title insurance. I can tell you something about that. Common money, common problems. That's what a condo is. There are huge risks inherent in condominiums. You need to be mitigating that risk, and you need to be talking to your lawyers about how you mitigate that risk. Title insurance is one of those ways. Brand new builds. We just saw a huge builder in the market completely dissolve. Thousands and thousands, in fact, hundreds of thousands of dollars were put onto new homeowners. Post-possession, we had subtrades registering liens for hundreds of thousands of dollars. How many of you would be surprised when I told you title insurance would have covered all of that? Now, here's the kicker. What's the average policy price? Most of the time, you guys are buying a policy within a $500,000 range, right? Or less. Now, for most policies, when you are buying a lender policy already, we're going to give you a discounted homeowner policy. So here's the biggest piece of it all. The way we do our pricing is $179 for the first policy under $500,000. The second policy is $50. Now, how many of you would like to protect yourself for $50? You're already buying the $179 policy. Get the $50 homeowner policy. And I'm going to continue to tell you why, but I have to always break it down to pricing because I'm Scottish and I'm just inherently cheap. So it always comes down to money for me. This is the kind of money that saves you thousands and thousands and thousands of dollars. The average title insurance claim on the homeowner side is $43,000. How many of you are willing to pony up $43,000 tomorrow of your own money to fix a problem that wasn't yours to begin with? None. It's crazy to even think about. It's a one-time premium, so unlike normal insurance where you have to pay and pay and pay and you kind of feel like you never get anything for it, title insurance is a one and done. You buy it, you own it for the lifetime that you have the property. This is also important from your owner-occupied standard. So if you're buying your own residence, you're gonna live in it for a little while and then you're gonna convert that residence maybe. This is a big strategy for a lot of first-time buyers. You buy, then eventually you go to buy your next one, you change that one to a rental. It doesn't matter to us. Once you've bought that policy, regardless of what you do with that property, it is your policy for the lifetime that you own it. Even if you convert it to a rental, you don't have to get a special rider. You don't have to disclose that to us because it's your policy. It is a policy for you to the title, and that is it. The only thing that's not allowed is it's not transferable because it's for that property's title and your name. So therefore, if you move to another property, you need to get one for that one too. Make sense?
So is that $50 a month or one time?
One time. You're gonna spend more money on coffee this month than you will on your title insurance policy.
Well, Carlos might not, but I will.
I was like, I spend that in like a week, Carlos. The second piece about title insurance that a lot of people don't understand is that we don't actually only cover you for the loss that you incur, but we have an obligation for what we call duty to defend. And this is key, and I'm gonna show you when we talk about fraud and forgery why this is so important. Duty to defend is actually FCT covering the legal costs associated to defending your positionary right on title. So not only if you have a situation where it's gonna cost you $43,000 because you have an encroaching garage, not only are we gonna take care of that for you, but when your neighbor sues you and you have $12,000 in legal fees as well, we're gonna pay that too. So now it's pretty fantastic. For $50, you're starting to save yourself a ridiculous amount. You can see why this is so important and why Jared and I had such great discussions on this, because it's really coming down to mitigating your risk.
So that first, so if you buy two houses, the first house is $179.
Nope. When you buy a house,
Yeah.
the first policy, which generally is the lender's policy for your financing, because lenders make it a condition of financing, because they don't want to absorb those risks either. So they condition that and say, you have to buy this policy for me to mitigate my risk if you want my money. So that's $179. Then you say, you know what, I want to mitigate my risk too. For $50 more, for $229, you've got both.
Got it. Thank you.
Make sense? I want to go into fraud and forgery because this is a specific piece of risk that you guys as investment owners actually are exposed to, I would say probably at a larger scale than most average consumers. And why I say that is there's a little bit of stranger danger component when you have a tenant. You need to know who your tenants are. It's not just their profiles. You need to know what is their capacity to pay. What is their likelihood that they're going to pay consistently? What is their likelihood that they may be savvier than you think? And here's why. This chart tells you what FCT has been found in our trends when we do our fraud analysis. We have actually identified $453 million come across our desks in fraud and forgery deals since 2012. $453 million. Now that's not the losses that we have taken. That is what we have identified from an exposure standpoint to say, this is yellow and it quacks, this looks like a duck. We're not touching it. And we go back to the lender or we go back to the homeowner and we talk to them about it. Now, what's really interesting about this is you're going to see two things. The 2% there, what that means is 2 cents of every dollar that we spend paying out fraud and forgery claims are related to fraud and forgery falling under a homeowner policy. What that means is we're actually not, on average, for a homeowner in a fraud and forgery case, paying out the loan amount. What we're paying out is the duty to defend component. When you move over to the far end, on the 57%, so 57 cents of every dollar that we pay out is related to fraud and forgery on the mortgage. That is where we're paying out the lender. And that is why lenders want the policies. Lenders want to protect 3 areas. They always want to protect their priority of registration, their validity of registration, and their enforceability of their registration. Because if you don't pay, they want to make sure that they can tell you you have to pay. From a homeowner standpoint, those aren't the types of risks that you absorb. The types of risks that you absorb are lack of building permits. So renovations, the handy dandy homeowner that just did it himself. the grandfathered, those kinds of things, the secrets. That old non-conforming garage that's over a gas line that somehow they got an occupancy permit and somehow they were able to proceed with this property, we see it all the time. I'm going to give you guys a few claims example stories just to give you an understanding, but it's really, really interesting what we see when we get claims. Fraud is one of our largest claims on the lender side, and our average claim for fraud is $123,000. Do you know that Alberta is one of the highest markets in North America for fraud and forgery? In North America. I'm not even talking about Canada, North America. It is because we have a bit of a transient nature. We also have an incredibly accessible title system. For $10, anybody can pull a title on any property, and we have a whole lot of snowbirds. It is so easy. Do you know how long it takes a bank to figure out that it was fraud? 180 days on average. 180 days. How far can you disappear with a couple $100,000 in 180 days?
So what do they do?
I'm not going to tell you because this is not an education seminar on that. You're going to have to meet me for drinks later and buy a lot for me to get that chatty. But you know what? We see fraud and forgery in a lot of different means. One of my favorite stories is a situation where a husband and wife were actually having marital issues. She left the property for a period of time, and they were co-owners on the property, co-owners on the policy. The husband and his girlfriend impersonated the wife and sold the house. She came back and she decided, you know what, I'm gonna come in, we're gonna talk, I'm gonna get some stuff out of the house. Well, there was another family living in there. So, not surprising, they didn't get back together. And what we did, even though they were co-owners on the policy, we actually paid her out her equalization. So even though she was defrauded by her spouse, we actually paid her her fair share of that sale. Pretty awesome. We try. In those cases, we do file legal charges, but we actually have a no-fault claims policy. So what that means is we're not going to go on a witch hunt unless it's worth a witch hunt. Because a lot of times, it costs you thousands of dollars to actually go after people, and it's just not worth it to us. In fraud and forgery claims or anything where there's an illegal activity, yes, we have to file it, but I'll be honest, we have friends that work in the Edmonton Police Service, Calgary Police Service, Toronto Police Service. I had a friend that started in the last couple of years. He started there about 2013, and he went to the fraud unit. They handed him a stack of papers from 2009 to start working on. It's a tough market. Fraudsters are good at being fraudsters for a reason. I actually say they are kind of like the ultimate entrepreneur. They just don't necessarily take it down the right path. And that's really what it comes down to. I spent 6 years working in the credit card industry, and they're like magicians, the things that they come up with. It's amazing, but at the same time, it's terrifying. And fraud is real. We have to be acknowledging that it is real. It is not Toronto and Vancouver. It's not just Edmonton and Calgary. It's little rural communities. So know your tenants, know your customer, know who is doing what in your properties, because you are exposed and you don't want to be exposed. Title insurance is the only way to protect yourself from fraud and forgery. It actually is the only type of insurance that covers you for fraud, not only from the past, not only from the transaction itself, but future. Most title insurance coverage is designed for things that have happened on the property before you take it. Because you as a homeowner, if you're gonna renovate, you have a responsibility to do it the right way. But you can't say that the guy before you did it the right way. And that's what your concern is. With fraud and forgery, you have a concern as an owner on the property for the lifetime that you are in that property. And that's really what it comes down to, protecting yourself. So even just for the $50, the fraud and forgery protection is worth it. Because that's a lifetime protection for you, just from a fundamental. This little example up here is a live example of what actually happened. A tenant impersonated a homeowner. And this is a great example for you guys who are interested in investment properties. Tenants are in your property all the time. If they are smart enough and savvy enough, they can figure out all kinds of things. Having a mortgage on your property is a deterrent, but it doesn't stop it. If you have equity in a property, and I know, Jared, last session we were talking a lot about buying down your property, making sure that you're cash flowing higher. You have equity, that equity is accessible. even if they have to pay out another financial institution. So what? It takes 10 days instead of 5 days to get access to the money? They've already impersonated your identification. They're not really worried about that. They purposely went to a lender that didn't know that person. I had a great talk with somebody the other day about how this exact situation happened to them, and the Bank of Montreal manager didn't even realize it, and they were personal friends. And they authorized the transaction. And then when they got the call, they said, oh my God, I think I'm losing my job. Because they authorized a transaction presuming that they knew that it was this person, until they found out, oh, well, Susie actually has brown hair, and the lady that came in to do the transaction had blonde hair. Oh, these guys live in Saskatchewan, and the transaction happened in Manitoba. How did that make sense? So you can see where some of these risks, though we're trusting all of our partners, we have to be asking the questions and we have to be mitigating. So what happens when long-term investment isn't your strategy? These are the flippers. These are the people that want to buy properties and sell them as fast as possible. Within your transaction itself, you do have risk. And it's important to know that your risk is something that you can actually protect yourself against. I've really only brought 2 examples today because I can talk for hours and hours, but this isn't my show, this is Jared's show, and I want to make sure you guys get the content. I'm going to stick around, so when you guys do have questions, I'll be here to answer them for you. But what I did want to do was give you guys a couple major examples. This one is one of my favorites. This is a homeowner that bought the policy because her dad was a finance person. He was a mortgage broker in Winnipeg. And he told her, you get that homeowner policy. Not even a year of living in their house, their pipes froze. Unbeknownst to these homeowners, and despite having great processes, they found out when they went to the city to get a permit to do some work on the property that there was actually an outstanding work order conditional to another permit that was going to be for an addition that was being built on the property. The addition wasn't built, but some of the work had been started. When we got involved, we actually brought an engineer in. When we brought the engineer in, they actually deemed the property structurally unsound and unsafe. We actually paid to move the family out in a bed and breakfast for 3 months. We covered all of the costs of lifting their house up. We fixed their staircase, we fixed their plumbing, we fixed their electrical, and we fixed their foundation. We paid over 6 figures on a house worth $300,000. We own 33% of that house right now. But the homeowner paid 50 bucks. 50 bucks for that peace of mind. These are the secrets in the walls that couldn't be predicted. The other one is one that I wanted to highlight for you, and this is a situation where we would have paid out had the individual had a homeowner policy. This is a situation where when they went to the solicitor, they actually declined a homeowner policy. They decided not to get it. Now, in this situation, this is where we had a registration issue. Did you know that 20% of documents when they hit land titles for registration are actually rejected as a result of clerical error? I don't know if you guys have ever tried to do anything with land titles, but it is a fight. We are the largest users of the land title service model in Canada at FCT. We actually do over 1 million transactions from an insurance standpoint every single year. And that is so important because we understand this. We know that there's a risk with this. Western Protocol is something that we have out here that allows you to close, meaning that you can advance money to a seller before your name gets registered on title. This is something where we call gap. There is a gap because, like all government things, they don't do anything on time. So there is a timeline gap. Now, if you get a convening registration that contradicts your ownership during that gap process, you as the new owner are legally liable for that registration now. In this case, these homeowners didn't have a homeowner policy, but a $21,000 registration came in and contravened while they were in the middle of the transaction. Had they had title insurance, we would have paid that $21,000. They did not. FCT was in fact sued, and the judge threw this case out and in fact said you should actually sue your lawyer because they didn't get you the homeowner policy and you should have had it. So this is why I cannot stress enough that you need to be asking the right questions of your realtor, you need to be asking the right questions of your financing professional, and you need to be asking the right questions to your legal professional. It matters to you because this is important. And that's really what I wanted to cover today, guys. So thank you so much.
Round of applause for Heather. Any questions? for Heather? Just a couple, just because I want to get to break.
So my question is, if I did get all the title insurance every time, but if you did not get it, can you get it after the fact?
Absolutely. You can get a homeowner policy at any time. Your most cost-effective option is to get it at the time of purchase because we're already doing a lot of underwriting for the lender. But you can get your own policy. You simply have to give us a call. I put a brochure on each person's chair tonight. If you look at the number on the back as an existing homeowner, you can just give us a call and we can go through getting a policy set up for you. Yeah.
Great. I got some questions. Does title insurance cover a collapsed sewer line if you were to buy it?
We do not cover septic or water potability coverage for homeowners. However, sometimes there is a roundabout way of achieving the same end point just because of the way the problems resulted. So if it was work done without a permit or there's a municipal enforcement from a government authority or something along those lines, then yes, we can potentially step in and give some coverage through those
Which
means.
would be the same as a foundation crack.
Exactly.
I actually tried to get.
And unless, and we would have covered that had there been a municipal enforcement from the city that said that had to be remedied.
Yeah, or an engineer.
Government authority. So the municipality, provincially, federally are kind of the bodies that have to come in. Condominium board also falls under that.
Okay, and then my last question is, does every bank require you to get title insurance?
Not every single one yet. I'm going to say it is not an if, it is a when. 90% of lenders today are asking for a policy that protects them. I would say that the remaining 10% will be moving probably within the next 5 years.
So if the 179 isn't cut, like the bank doesn't say.
Then your base cost would be 179, right? So if the
you're just
bank,
buying one policy.
you're just buying one policy, so
And
then
I'm
you,
just buying the policy for myself,
bang on.
not the bank.
Yep. So the way we look at it, I call it a BOGO. I'm a shopper. So you buy one, you get one at a reduced cost. The lender is going to step in the first place, but in the event the lender doesn't require one, then you are the one and done at 179.
Awesome. Yep. Two more.
If
Carlos.
you're joint venturing with someone and you're not on the mortgage, can you still be put on the title if you show a joint venture agreement?
So if you're,
So repeat the question.
so if you are on a joint venture, can you go on the title insurance policy? Are,
You're not registered on title as the partner, but you have
no.
a legal dog.
We're gonna put it, you could apply to us in that case and we would maybe consider it. We'd need to understand your interest stake into it because generally what we're doing is we're coding title, like title holders to property. So really that's where the policy is gonna come in. You're gonna have to give some supporting documentation through that for us to consider.
What last one?
Suppose a condo was built incorrectly, okay?
Mm-hmm.
And they got all the legal stuff. Is this covered to cover any legal?
We actually have a special condominium endorsement that is exclusive to FCT that we actually built because of situations like that. My personal favorite is everyone's four-letter, I call it a four-letter word, just longer, special assessments. Undisclosed special assessments are probably one of the biggest things that we have. Condominiums in Alberta are run some really well, some not. And there's really no legislation around that. And that's what gets a bit scary because it is the wild, wild west. Without that, being that condominiums are basically the board is made up by unit holders, you have no idea who those unit holders are or their interest stake. We've got a lot of condominium boards where developers are on the board. Now, an interest from a developer versus an interest from a unit holder are going to be very different. An interest from an investor is also going to be different than that of an owner occupied. So it's understanding the makeup of that. With the condominium, I do have some additional information. If you want, we can talk at break and I can share specifically on the condo piece what some of that risk coverage is.
One more question for me, right here. I'm talking.
Always questions.
Would FCT cover that stuff that happened in Fort McMurray with those apartment buildings?
Which stuff?
Does anyone remember that they built these apartment buildings wrong?
They were built incorrectly.
They were built incorrectly and they literally abandoned all these buildings. Joist collapsed, it was just.
There'd be some potential coverage.
Yeah.
It would be situational, and it would all come down to what was known at the time the seller or the buyer acquired the property. So we always look at known defects have to be fully underwritten, and unknown defects obviously are coverage.
It's
So
safe to assume that none of those buyers knew that.
I would say most of them didn't, and as soon as there was a municipal enforcement on that work, then yeah, there'd be some coverage.
Okay, was this good? I thought it was great. Okay, so once again, I wish I had known about title insurance in 2003, and I have lots of clients that have bought houses that I wish they knew about title insurance. I have one guy named John bought a house from a renovator, he bought a house that was, the seller wanted to renovate it. He ended up paying the guy $30,000 to renovate it. I'm like, John, there's no way he can renovate that basement suite for 30. No, he said he could. And after he closed on it, within 2 weeks, we had the basement gutted and pipes were leaking and it was just a mess. Electrical was behind the wall uncovered. He had pot lights in the ceiling that were on but not sticking out, and it was massive. We took this whole thing apart. He ended up spending 80 grand for us to slowly take it apart and then for us to rebuild it. So I wish I knew about title insurance. For $225 to me, it seems like a no-brainer. If you can't afford the $225, you probably shouldn't be buying the house in the first place. So let's start playing the game properly. And if you play the game properly to win, you'll win every single time, I guarantee it. If you try to cheap out, and you probably won't win. So with that said, during the break, a couple things. First of all, Vinny Fiacco, Mona, and Keith, if you can come up here, Darren and Wayne, if you guys can all just slide up here really, really quick. That means you guys get up and come up here, stand up and come up here. So when I came up with this idea of the Tilt Action Group and our workshop, I wanted to put people in front of you that I use. And I went to every single one of these people that are coming up right now and said, listen, I want you to be part of my group. And most groups, the way they're organized and the way they're set up, and I know because I've been around groups for the last 10 years, is that they back-end deals. So they'll put you on stage, you'll allow to move a product, and they're going to pay you 25% of every deal. That realtor, that agent, that whoever it is going to pay that group 25% of every deal they do. I have an issue with that because I think it questions the integrity of the product. Okay? These guys don't pay me anything. So in order for us to keep our costs down with our membership, which is we're going to talk about after the break, once Arlen and I get going, is I went to the guys I use. So Mona Crandall works for CIBC. I've done many, many, many mortgages with Mona. Wayne Herbert is an accountant. He's my accountant for the last 15, 16 years, long time. Darren Richards is my lawyer, our lawyer. Best, like, these two guys are the best things that ever happened into my business, from protection and growth. And April 30th is your busiest time of the year. Yeah. And I'm going to call you 4 times. Vinny Fiacco is an agent with Remax Elite. He's not even part of my group. Keith Faria is another agent, which is part of our group through Century 21. And I have Geneva Tatro in the back, who's also part of our group. These are my premium service providers. Okay, so what we've done is we've pooled all of our marketing money. So we all chip into this little pot and put all of our marketing money, $400, $500, $600 each, into this pot, and we market it. Okay, that's how we're doing our business. So if you do a deal with Mona, I don't go up to Mona and say, hey Mona, you did 10 deals, give me some money. That's not how this works. So we also will bring in another broker, we'll bring in another agent. We're going to bring in the people that I feel are going to protect you. So these are our premium service providers. Once again, Mona Crandall, she's with CIBC. Wayne Herbert, my accountant. Darren Richards, accountant. Vinny Fiacco, realtor. Close, lawyer. And then Keith Faria, another agent. So during the break, if you have any questions about legal, there's some guys who had questions about corporating. If you have any tax questions, Wayne's here. You have a mortgage question there, agents, property to buy, come talk to these guys. There's also a lady, wave your hand, Sasha in the back. She just started with us a month ago. Sasha's running all of the events, so if you have any questions for Sasha about what we're doing, ask her. Round of applause for our premium service providers, please. Thank you, guys. Two last things before we slide to break. I asked Teresa Bruzzi to come out. Teresa runs my collections department in the back. So Teresa is, you can't really see her, but she is standing. It looks like she might be sitting. But Teresa runs our collections department. If you want to understand how tenants think and what you should be doing or what you shouldn't be doing, she's a great resource. Teresa just took one of my former tenants to court, and I think we're going after $5,400 or something like that. Actually, it was more than that. It was $9,400 you're going after, because Teresa wanted to try to take them to court for next month's rent that they didn't pay. So we went to court trying to get one more month's rent, and we never got it, which is funny, which is great. But we ended up getting $5,400. And so we put it on Facebook, and someone put a post saying, yeah, but how often do you collect on this? All the time. Because here's what's going to happen. This tenant who owes us $5,400, who's paying us $225 a month. Okay, she's going to pay me $225 a month until this debt's paid off. But what's going to happen is, If she didn't pay me that, I go get a judgment. She says, beat it, I'm out of here. Good luck trying to collect. In 10 years, she's going to try to get a mortgage. She's going to try to get a car. She's going to try to open up a bank account. She's going to try to get a cell bill. She's going to try to get something. And by then, even right now, everyone's doing credit checks. So then what's going to happen is she's going to call me up, and how do I know this? Is because it's probably happened 10 times to me. Hey, yeah, Jared, I rented from you 10 years ago. I got this debt on my bureau. Can I pay it? Yeah, no problem. Well, it's $5,000. You want to settle at $3,000? No, I'll take $5,000. Because they have to pay it. So why the hell would I negotiate? I've waited 8 years to collect it. So the whole point is if you screen your tenants properly, I always look for 3 things. Are they going to pay on time? And are they going to take care of my house? In the event that they don't, can I screw them and win? Does everyone see that? Because if I can screw them and win, then I'll rent to them. So if you have any questions about collections, Teresa's the one you want to talk to. One last thing, we are supporting the food bank. If you have any perishable items, any food, some people have brought some stuff, dropped some stuff off. Every few months we're going to change. There's the Hope Mission I want to get involved in. There's a lot of, as the economy starts picking up, it's going to get harder and harder for people to live, find places, food, shelter, stuff like that. So food bank, we're absolutely supporting the food bank. So after the break, as you go on break, there's a form. If you decide to leave, that's totally okay. Please fill out the form. I love feedback. Heather Toma left some packages on the side. If you want some information about title insurance, check it out. They're all right there on the side. After the break, we're going to do 10 minutes. So there's a washroom right there. Go grab me a quick beer, come back. My presentations get better the more I drink. So 10 minutes from now, we have about 5-2, okay? And then Arlen and I are doing a joint venture thing at the end, and it's going to be deadly. Thanks, everybody.